Markets are trading at record high levels. On Wednesday, we are expecting a Fed announcement and maybe a Fed cut. 97% of you probably expect a 25 basis point cut, but what is the messaging going to be? What is Jerome Powell going to say in the press conference? We will pay very, very close attention. Join us for a live interview on Wednesday night with Lobo Tigre, right after the press conference of the Fed, to dissect what has been said and where things are headed. So really, really interesting. But before we get to that, I've invited a fantastic guest to discuss sort of the data that the Fed is using to make its decision. And of course, he's based in Canada. So we'll take a look at the Bank of Canada decision on Wednesday as well. They're supposed to cut by 25 basis points as well. So lots to discuss in a very short time. But before I switch over to my guest, who is Martin Pelletier, by the way, he's a senior portfolio manager over at TriVest and Wellington Altus Private Counsel. Really looking forward to catching up with him. It's been way too long. But before I switch over, as I said, hit that like and subscribe button. Helps us out tremendously, and we much, much appreciate that. Martin, it's great to have you back on the program. Thank you so much for joining us.
Betcha. Thanks for having me.
Yeah, it's been way too long. It's been over a year. I looked up the date, and it's been too long, Martin. So let's start fresh. Let's start with a white piece of paper before we get into the details. Martin, what is your assessment of the economy and the financial markets right now, Martin?
We're in a liquidity-driven market. About a month and a half, 2 months ago, I went as far as to say that there was potential for a melt-up, and we're seeing it now. And the big question is, how long is that going to continue? The market's factoring in several rate cuts in the U.S. The market's factoring in a continued large fiscal deficit spending. All of these are extremely inflationary to asset prices. And so you're seeing Bitcoin, for example, move higher, the devaluation of the US dollar, and gold setting new highs, and equity markets, especially long duration equities, pushing new highs and continuing to establish some really strong momentum. So, we'll take it as an investor and for our clients we'll accept the asset price momentum here. But, longer term, we do have some concerns.
Obviously, I think the labor market and even inflation, I think we need to dissect those two together here, Martin. Maybe we'll start with the labor market. What is your impression here? Like, what kind of signals or what kind of signal is it sending to the Fed, and how will the Fed use it to make a decision?
Well, looking at the U.S. in particular, the labor market is showing signs of weakening. There's been some revisions to some of the data that we've seen. However, zoom out and take a bigger picture. We're still at 4% and change in unemployment. That's a pretty good number. Certainly a lot better than where it has been in the past when the Fed has cut rates, and better in the past when you've seen fiscal deficit spending like we're seeing now, similar to the 2008 financial crisis. And so there's a disparity between between some of the economic numbers we're seeing in the U.S. And the fiscal and monetary policy and some of the concerns.
No, 100%. And I think the trend is the worrisome topic here. It's not really the number itself, 4.3%, although even the 4.3% is debatable because after the revision, that number hasn't changed because we lost almost a million jobs and we're still at 4.3%. The trend, because you were talking longer term trend, hence I brought up the employment topic. Where do you see things headed? Where do you see the cracks in the industry, in the market, or not markets, but in the industries? Where do you see pressure coming from?
I think we're going to see political polarization. I think that's the biggest risk. Asset inflation from money printing over the last 15 years has widened the economic gap between the wealthier and the poor, Main Street and Wall Street. And undergoing another round of stimulus and money printing is only going to widen that gap further. It's not going to help Main Street whatsoever. So yeah, 4.3%. You look at the unemployment level among younger people, it's much higher. And there isn't the same kind of job opportunities for younger people in the US. And so when there isn't the opportunity for employment or even to buy houses, given the lack of affordability, and Canada's a much different story, much worse, then you're going to have some of that polarization. And could be a destabilizing factor within the U.S. And that's a concern of ours longer term. And so the approach being taken by the Federal Reserve under tremendous pressure by the White House to cut interest rates in a period of time where the economy is still doing okay, a period of time where inflation still exists, and we have had a material increase in asset prices or cost of living since COVID, that we haven't seen any sort of a deflationary return to where we were pre-COVID. That it's just going to make the problem worse. So I think it's just kicking the can down the road, and it's going to create more instability. And in the near term, if you are long stocks or long anything that's going to benefit from that, then you're going to win. But if you're on Main Street looking for a job, you're not, and this isn't going to help.
Yeah, it's like one statistic that has me worried is the youth unemployment. People just coming out of college or just out of high school is over 10%, if I'm not mistaken, in the U.S. Reminded me a bit of Spain, which has very high youth unemployment as well. I'm comparing apples to oranges here, but it is worrisome, is my point here. Do you see that change at all? And like, what can we do? I don't think a Fed rate cut will make it any different here.
And tariffs, the thesis behind tariffs is it'll cause more reshoring and more jobs for these younger people, and I don't think that's going to play out exactly. Corporations are holding on to from passing those tariffs along to consumers, so they're not going to be hiring because they're taking a hit on their margins, and eventually that will have to get flowed through. What you really need is you need to address some of the underlying issues around that. And so you have to focus on the education, how to repurpose the job market for a lot of these younger people, and not just blame immigration on it, although it is an issue in Canada with temporary foreign workers, not nearly the extent as what what's happening south compared to what's happening up here, where that unemployment for young people is 14 to 16% in Canada. So we've got a much bigger issue. You need to grow the economy, and you need to grow your way out of it. And the policies are more inflationary on assets than broader economic growth, in my opinion.
Yeah, it's tricky because you need to get out of that GDP to debt bubble as well, meaning that ratio needs to shrink as well. So you do need to grow. But where do you see growth potentially happening? You touched on tariffs, bringing some of the production home. I think we also discussed, Martin, before the AI boom to a degree, maybe helping with productivity, but also having just the industry onshore, meaning in the U.S. might help. What can the U.S. government do? Is that enough? Just the CBO just put out, the Congressional Budget Office, by the way, just put out numbers for August, I believe. So the budget deficit is shrinking slightly due to tariffs, but I think it's more of a drop in the bucket than anything else. I'm curious what your take on that is, and what can the U.S. actually do to really stimulate growth besides print more money?
Well, printing money is stimulating not necessarily economic growth, but financial engineered growth. And so that's going to, again, probably make things worse for the person on Main Street. The person on Main Street is actually going to suffer from tariffs, in my opinion. Farmers are suffering from this ongoing trade war, and various segments of the market are going to be suffering, in my opinion. Tariffs, there's been talk about giving those tariff revenue back in the form of some sort of special dividend. So the fiscal deficit is what you need to get under control. So if you really want to help Main Street, you have to have a deflationary impact on asset prices to actually make it more affordable. So, for example, you were much better off when you could buy a house at an 8% interest rate when a house was 2 times your income, whereas if interest rates are at 3% and housing is 10 times your income. So you're better to have, in my opinion, longer term, higher interest rates with fiscal responsibility and eliminating the deficit. There's no need for running a deficit in the current economic times. We're out of COVID. We've been out of COVID for a long period of time in regards to the necessary repercussions of shutting down the economy. And so we need to adjust back to a normal baseline, and that means fiscal responsibility. Now, the bond vigilantes are going to hold governments accountable. Maybe not in near term. Near term, longer end of the yield curve probably could come down, and there's a trade there. But in longer term, it's going to continue to stay high, and that's not good for bond markets. And that's going to hold these governments accountable. And you're going to see devaluation of currencies like you're seeing with the US dollar, which is not good for necessarily for Main Street, depending on if they can harvest that and turn it in, harness it, sorry, and turn it into export growth. But globally, fiscal irresponsibility needs to get under check.
Yeah, you're touching on a lot of topics, and we'll get back to the housing market in a minute here, Martin. But first, let's stay on the inflation topic real quick. Curious what your take on is. Like, do you think tariffs are inflationary, deflationary? I've heard all sorts of things here on this channel over the last few months, and I'm curious what your take is on it, because it's a good segue to the next topics here.
I think they're inflationary because of the response from them, not necessarily the tariffs themselves. It's going to be the response to it. And so if you look at the U.S. government, if they do a dividend back to the consumers as tariffs eventually get passed along to consumers, and they will, there's going to be a response potentially from the government to react. And that means forcing interest rates lower by the Federal Reserve. And that means fiscal spending continuing to remain high. And that's going to create an inflationary type of environment, which isn't good for Main Street. So it's not necessarily the tariffs themselves, it's the response to the tariffs on monetary and fiscal policy that I think will be inflationary. And it's the same argument that people have said, well, we haven't had inflation for the last 15 years. Well, we have. Just look at the debasement of the U.S. dollar over the last 24 months, and look at gold and what the gold market is telling you, and try living day to day on a $50,000-$60,000. I think that's the average income level, a year. Try living on that when housing prices are high, rent prices are high, albeit coming down a bit, and food prices are extraordinarily high. And so, yes, I think this is not the proper response of deglobalization. It's going to compound the rising price pressure.
Talking about rising price pressure, like the housing market is a very interesting topic. I've been talking, like last week I was in Beaver Creek at the mining conference, and a few people told me that housing prices in Canada, in Vancouver, for example, are down by 10% roughly. How much false hope is also sort of connected with a cut in interest rates in Canada, but also in the U.S. When it comes to housing prices, the mortgage market, and things like that? It seems like there's a lot of false hope being priced in or expected when it comes to that discussion.
Well, I think this is where you have to look at demographics. You have a baby boomer generation that has benefited tremendously from rising housing prices and from falling interest rates. 30, 40 years of falling rates have been very inflationary for their probably their largest asset. Now they're going to have to offload this eventually, and who's going to be the buyer of it? And so in basic supply, my son's taking economics 101 at Mount Royal University here in Calgary, and it's fascinating to see how majority of society has removed themselves from the economics 101 scenario. And supply and demand. And so there's going to be a very large supply of housing and not a lot of buyers. And you look at Japan, for example, and what that's done to its housing market. So eventually you're going to see that end of the market come down. And if you have an opportunity to capitalize on it, and if you're looking at your benchmarking, well, yeah, how prices are down from their COVID highs, but let's take a look at, let's go back 5 years ago or 6 years ago or 7 years ago and look at where the prices are compared to then. And you're still up significantly, or even up from a decade. And this is a time probably not so bad. If I was a baby boomer, I'm Gen X, but if I was and I had a nice big house and my kids weren't living in it, then there's nothing wrong with the 4-letter word, rent. And I talked with a friend of mine in Toronto, and he rents a place in Italy for 6 months out of the year, and he loves it. And it's renting, and he's furnished it and done everything he's done. It's a beautiful place. There's nothing wrong with renting. And this individual is a very, very wealthy individual. And so putting your capital to work in other areas of the market besides your housing, because I think that trade's yesterday's trade.
Yeah, it's an interesting topic because in Germany we're a renter's market, for example. In the U.S. is more an owner's market. It's the part of the American dream to own your own house, but I see that shifting slowly. I know nobody should be attacking the American dream here, but the market fundamentals are sort of dictating that. Is that a statement you would agree with, that we're moving more towards a renter's than a buyer's market or owner's market?
Well, as a young person, you have no choice. I mean, especially in Canada, the average income required to buy a home in Canada is 220,000, I think, or something like that. And Canada considers you the wealthiest at that. So the average first-time home buyer is 40 years old in Canada, and you're taxed the highest level. Anything above what you earn, you can't pay down the house. And so we're already there. Now, if housing prices correct and you're renting and prices come down far enough, then you're going to benefit from it. Now, lowering interest rates is just going to delay that. It's just going to maybe create some temporary demand because people leverage up at 10 times their income, whatever the number is, to buy that house. And it just prolongs the cycle. But eventually, ages and demographics are going to work against the housing market. It has to. So maybe it's 5 years from now, maybe it's 10 years from now. What's the average age of a baby boomer? Is it 75 or 70, 75? And you go another decade from now, 85. I mean, you're sitting on a multi-million-dollar house, and it's just you or you and your spouse. Eventually that's going to get sold.
No, it's a nice nest egg to have, of course, but it'll hit the market as quickly as it can sometimes, and I've seen that happen. Martin, let's get to the here and now. Wednesday is the Fed decision, of course. The press conference, we're all waiting for it, holding our breath more or less, because we don't really know what Jerome Powell is going to say. Market expects around 69 basis point cut by the end of the year. 25 points now expected for Wednesday. What should investors do? I've been hearing quite a few stories that our investors are starting to get out of the market, waiting for Wednesday to happen before maybe considering coming back in. Like, what are you doing? What are you looking at? And is that the right strategy?
Oh, well, trying to make predictions like that is impossible to do. It's akin to gambling, but betting on red or black. If I was to place that bet, though, I think you're going to see the Fed, who's under a lot of pressure by the White House, try to keep everybody happy. And by keeping everybody happy, they're going to disappoint everybody. I've learned that from personal experience. And so you have to make tough choices. But I think they're going to go 25 points and provide more of a, what would I call it? Being, somewhat hawkish, but not overly hawkish, and they're going to take that approach. So that I think that's probably going to upset the White House, and it's probably going to upset those who think they should be dovish, and maybe markets pull back a little bit. Now markets are expecting, like you said, some material rate cuts over the remainder of the year. They're pricing that into the long duration side. You can see that in the tech stocks. And that's probably going to continue to happen.
Yeah, I've been asking other guests about the potential deflationary scenarios, meaning 25 basis points now, 25 basis points at the next meeting, 25 basis points later on. All depends, of course, on the messaging by Jerome Powell. But why would you now invest or buy a property or get a mortgage when you know it's going to get cheaper in December? So that's sort of the question. Like, what do you make of that sort of messaging here? And what do investors make out of it as well? Is it deflationary? And what is your take on that?
Well, I think if you're going to be buying a house, your house is no longer an investment. So I think you want to remove that from the equation. If you're going to be buying a home, I think you're probably, just look at the opportunity set, look at where the situation is, and do it for a lifestyle choice. From an investment standpoint, that's going to be really hard because if there are rate cuts coming, more rate cuts, is that going to be inflationary to the housing market? And so maybe you want to buy now ahead of those rate cuts. I'm not sure. That's a really hard call to make. From an investment standpoint, I think we're going to continue to see some strength and the strong momentum as markets are lobbying very, very hard for rate cuts. And I think there's probably a near-term trade in the bond market on this. Now, longer term, there's going to be some serious consequences from this because I think the U.S. economy does not warrant material rate cuts. I think inflation levels do not warrant material rate cuts. I think the Fed holding pat, and a lot of people would very much disagree with me, but I think we need to have fiscal responsibility, and we need to have interest rates that can enforce that fiscal responsibility from a household level and from a government spending level. In the U.S. anyway, Canada's, we'll talk about this, but Canada is in a much different scenario where it would warrant some rate cuts. But having said that, the world's largest market economy is still doing okay. It's not collapsing. It's not. I mean, things are okay, and I think rates match the level of the economy right now.
Yeah, some guests have been saying that maybe the 2-year, or the Fed funds rate should more or less match the 2-year bond yield, which is about 3.5% right now, more in the neutral territory. Is that something you would agree with? That's something that'd be agreeable for the markets as well?
Yeah, I wouldn't disagree with that. I mean, I like the. I mean, I'm. If you look at the impact of my thinking and my generational thinking, I'm more conservative. And I think that's probably more of a prudent course of action. I think we need to have higher rates. Higher rates will encourage smart actions and remove some of the froth that we're seeing. But the markets want their fix, and they're going to get it.
True, and we've tried removing some of that froth earlier the year, and it ended in disaster, at least politically for some. We don't have to talk about the fallout between President Trump and Elon Musk here, trying things to change course, but it's not really working, quite honestly. People have gotten too used to the easy fix, which is cheap money. And
right. Yeah, and they're going to get it again. So,
yeah.
But as a portfolio manager and investor, I mean, it's good for me and my clients. I mean, and that's great from what I believe in ethically and what we should be doing for Main Street. That's a whole different story. And I think we don't need to have a widening of the gap between the wealthier and the poorer. And the wealthier have done okay, and if they could generate a rate of return that is sufficient to meet their lifestyle goals, which is often mid to high single digits, they don't need double digits. And if that allows asset prices to come down a little bit, not have the same kind of growth that we've seen, then you have younger people that don't need to take huge risks or huge swings in the market so they can be able to afford a home, so they make money in the market so that they can come up with that down payment. And it's more of a balanced type of approach. But we haven't seen that in 15 years, and you have the average age of a trader that's 35 that has never been through any sort of material correction, and they're always expecting the Federal Reserve to bail them out, and that's going to continue until it can't. Until bond vigilantes say, we're pushing back. You can cut rates all you want. The long end of the curve is staying high, and if you try doing bills to fund your deficit, that's going to run out of time. Maybe try and do Coinbase or some sort of government-backed crypto that you can devalue, but that's going to hammer your dollar if you devalue that, and we're going to hold you accountable. And there will be a day of reckoning from that aspect, and gold markets are telling you that. And so, enjoy it now. It feels good, but you're going to have to pay for it at one point or another.
100%. And I've been saying that since 2008, and I've been proven wrong. I've been proven wrong again and again and again. Yet we're kicking the can down the road, and yet here we are chatting, Martin. But maybe to turn this thing around a little bit, and we're always doom and gloom here, but where do you see some opportunity? You touched on the bond market, that there might be a bit of a bond rally happening with Fed cuts imminent here. Where else do you see opportunity with the S&P at 6650, gold at 3650? Where do you see opportunity?
Well, okay, so I think you want to move away from passive investing, and you need to get some good old-fashioned stock picking. And we've added another portfolio manager in our team who's really good at that, and it's been beneficial for us. So, for example, we were able to reduce our S&P broader exposure and go into some individual names like Google. That's worked out well for us. Berkshire has worked out well with the Apple participation recovery. So if you do some stock picking, there's some good opportunities there. I like the global infrastructure space. I think governments are going to continue to try and help boost their economies through infrastructure spending. You're seeing it in Canada. and so there's some good Canadian stocks that are going to benefit from that. And so I think if you really roll up your sleeves, there's going to be some good buying opportunities that haven't participated to the same extent from yet that the long duration equities have, and there'll be some good returns there.
100%. Like, what do you make of commodities? I know you're in Calgary right now, so we do have to touch on oil. You can't escape it when you're there in Alberta. What do you make of the oil market right now? Trading around $60 a barrel. Should we go higher, lower? What's the trend here?
It's going to be range bound. We reduced our energy position materially at the beginning of the year, and we're quite happy about that. We've taken our energy position down to probably an underweight if you compare it to the TSX for sure. And that the energy trade really helped us in 2022 when you saw rates rapidly increase. So we're not. The whole point is, we're not shy away from. We won't shy away from going to a large overweight position. It really helped us. We're only down 1.7% in our balanced fund compared to our peers are down 15 to 20%. So it really helped us, and we've reduced that trade down significantly. And so I think energy is going to be range bound. I went to Vienna. I met with OPEC back in March. I feel confident in OPEC's ability to maintain a stable oil market. They are coming after U.S. shale. I think U.S. shale is in trouble. I think longer term, that end of the market is going to probably really disappoint, and you're going to see some production shortfalls there. As if you look at the well data, they are experiencing higher water levels and gas to oil ratios. And so that trade in itself is setting things up. Global inventories are low. So in the next 5 years, probably a good trade, but not a lot of money made in the next. I mean, some M&A in Canada, we benefited from the MEG trade, so that's worked out well. Looking for the next one. So there'd be some nice little trades, but overall, oil, it's probably flat, dead money.
Maybe as a follow-up there, Martin, like how important is the oil price to the global economy right now? If gold were to be at $80 or $100 a barrel right now, do you think we'd already be in massive global recession or even depression?
No, the oil price is really it's in the sweet spot. It's fantastic given the state of the global economy. And like I said, I think OPEC's done a really good job of recognizing where the economy is at and having the oil price reflect that. And the markets are when the price gets higher, it's been pushing back and selling it down, and you're having some extra, the OPEC volumes coming back on. You've got Russia, which is a wild card. We'll see what happens there. Trump had a good point. If Europe really wanted to help push back against Russia, they'd stop buying Russian oil, but they're still doing it. Overall, I think it's in a great spot right now, and I think we're going to see a chug along U.S. economy, chug along a global economy. China's chugging along, and so it's just kind of a flat outlook.
Yeah, I was just in the U.S. last week, and I saw in Idaho a gallon of gas was $2.42, I believe. Then down in Colorado, it was $3.40. Still extremely cheap. So yeah. I always call it the low gas price QE for the people, right? Yep. What happens if we take that away, right?
That helps Main Street. That really does help Main Street. So if you look at forget about interest. I think interest rates. I talked about that. How that isn't beneficial. You want asset deflation, but if you don't get that, at least if you can get gasoline prices down. But what's gasoline price? Look at your budget. How much is gasoline as a percentage of your budget compared to food? And I like fast cars, so I burn through gas like there's no tomorrow. So it is a higher amount, but it's not as a percent of my budget isn't. And food prices are really high. And that's the other area that needs to get addressed. So yes, lower gasoline prices, fantastic for all of us on Main Street, especially those who are poor. It's great, but we need more than that.
No, fantastic. Martin, really appreciate your insights. It's great having you on back on Soar Financially. Really great discussion here with a Canadian perspective. Martin, where can we send our audience to follow more of your work?
You go to my website to TriVestWealth.com, or also on Twitter. I'm sure you can probably post my Twitter handle on here. I've got a good following base there. And I also do a Write for the Financial Post on a weekly basis. You can find me there. And we have a monthly newsletter that please, it's free for now. It won't be free forever, but we talk about some of the trades and some of the ideas that we share with our clients.
Fantastic. Martin, really appreciate you coming on. Fantastic insights. And everybody else, thanks so much for tuning in. Really appreciate you watching Soar Financially ahead of the big Fed decision. I think we're overhyping it almost a little bit here, not just on Soar Financially, but globally. The media is hyping it. We'll see what Jerome Powell says on Wednesday. Join us for a live interview with Lobo Tigre right after the press conference here on Soar Financially on our YouTube channel. We'll put up a live link here shortly as well. Thanks so much for tuning in. If you have any comments, put them down below. Go follow Martin, follow us, and we much appreciate your support. Thank you so much for tuning in. We'll be back with lots more. Take care out there.